We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Vermeulen, founder and chief market strategist of thetechnicaltraders.com. How are you today, Chris?
I'm great, Tom. How are you?
Excellent. Good to have you back. It's been a little while since we've spoken, so I'm looking forward to this discussion here today.
Yep.
So, Chris, after the broader market sell-off that we've seen over the past couple months, are we seeing a reversal in sentiment coming into the markets here?
I think we're starting to see some interesting price action. We're really at a key turning point, I think, in the overall stock market and sentiment of the investors. We're kind of in what I call a complacency stage. And the best way it really is for me to just kind of show you a drawing of where I think we are. So let's take a look at the S&P 500 first here. If we look at the S&P 500, this is the futures daily chart, and we zoom way out here. We've had obviously the COVID crash, and we've gone to this big renewed kind of bull market. And then we've had this big correction, 20+% correction in stocks. Everyone became very bearish over here. People started liquidating, and they were flocking from the bond market. I mean, finally, I think investors hit a threshold where like, oh my gosh, my bonds are down 20% this year. And so were stocks. And generally the market hasn't moved that way, not for the last 40 years. If the stock market sells off, we typically see bonds hold up in value. As money gets scared out of stocks, it moves over to bonds. But this year, everyone got really spooked, and more so, retirees, people who are heavily weighted in bonds and are wanting consistent growth or stability, and they didn't get that this year. So we definitely are seeing this big wave of selling, and people are just now starting to buy again. And if we take a look at where we are in this kind of emotional roller coaster ride for investors, here is a graphic that I have. This is the emotions of investors. And more or less in 2020 and early 2021, we saw this thrill euphoric phase. Everyone piled into stocks. And then this year, we've seen the market really crash and break down. And this has got everybody spooked. But now we're going to what I call the complacency rally, where we're going to see sectors and stocks in general start to move higher. Probably won't be very strong, and it'll be choppy. But investors right now are starting to move back into growth stocks. We actually had a buy signal in growth stocks a couple of weeks ago. We've already locked in profits on 7 positions, moved our stops in the money, and we're positioned for this market to keep going higher. But if it rolls over, we'll be ready to take advantage of the downside, because after this complacency rally, we're going to go into what I think is going to be a very big potential, the first real leg down in a bear market. And so, as you said, the sentiment right now is just shifting. People, I think, depending on how you're looking at it, people were very nervous. They all panicked out over the last month. Now they're starting to move back into stocks, and we're going to create this rally. This is where precious metals and miners actually should come to life. Typically, this is where they become one of the strongest sectors, and they'll outperform pretty much the stock market for several months. So this is going to be very interesting. If precious metals really take off here, that is going to be an actual warning sign that a bear market leg down is coming next. That's the way I see it. That's the way I've seen this happen over and over again in history. So I don't know if that answers your question or not on the sentiment, but people are just starting to turn a little bullish again. But it is really just a false rally, and people are going to get sucked into this market, and then it's going to drop again.
So are you saying that, you're moving into these growth stocks simply because, there's been so much momentum and so much money made in that is a good place to take advantage of some of that momentum, despite let's say the fundamentals of them?
Yeah. So I could care less about the fundamentals. The reason that we're seeing growth stocks, I think, take off is everyone piled into them before. Everyone now has just been, beaten up really bad. Anybody who's held growth stocks are down anywhere from 35 to 80% right now. And typically when they start to get a little bit of comfort back in the market, when they think, the market's corrected and the bear market is over, which so many people are starting to think and feel, they stick their neck out one last time to kind of average down and buy back into the growth stocks. And that's what we've been seeing. Growth stocks have been outperforming the stock market, the general indexes. They're coming back to life. And people are just kind of moving into those, expecting those to go higher. And it's kind of just like, people are doubling down, and whatever people made a lot of money on in the past or were up really big, they tend to want to do it again. And so that's the money I think starting to flow in here. I think this is a complacency rally is like a sucker's rally. It's going to suck you back in. You're going to put more money to work. You're going to hope and pray that, we're starting a new bull market, but it's going to be the exact opposite and leave everybody holding a bag of really bad stocks, potentially 2, 3, 4 months from now. They'll be holding them at a high price, and it'll be, dramatically lower.
So, Chris, is sentiment really the only thing that has changed? Last week we still saw that 75 basis point hike from the Fed. So, we've seen the markets react favorably to that announcement. So, is sentiment the only thing that has really changed there?
I think we're seeing a lot of money flow out of the stock market. I think we're seeing big institutions becoming very protected for the downside. I think a lot of people are trying to get into cash positions. They're trying to hedge themselves, thinking this market's going to go lower. I mean, sentiment is what drives the stock market. Is everybody feeling good, or are they feeling nervous? That's pretty much what draws the chart. Every rally and sell-off is just a wave of people being really excited about something and running and chasing and driving the price higher, or fleeing from it and panicking out. So definitely sentiment has changed really since early 2001. You can't see it on the stock market when you look at the S&P 500, but right at the beginning of 2001 is where growth stocks, where big money investors stopped dumping into growth stocks. They were way overvalued. The best example here is the ARK-K ETF. If we go back and just take a look at this real quick, if we look at the overall stock market cycle where it goes from a base into a euphoric rally, a blow off top, and then a complacency kind of pause and rally, and then a bear market, and then flat lines. That is, very similar. Like if you look at it from 4 stages point of view, there's 4 stages to a stock market. Stage 1 is dead money. You don't really want to be involved. Stage 2 is a bull market. It's a strong trend. It's green because that's where you can make money, is during a trend. Stage 3 is topping. You don't really want to be trading or investing new money there. And stage 4 is green because it's a very strong trend. You can make money when things fall. Now, when we take a look at the ARK ETF, you can see that we've gone to stage 1, stage 2, huge blow off phase, and then it's cracked. We had a complacency rally, and we're in a bear market. And so this is right at the beginning of 2001. Growth stocks fizzled out. So growth stocks are starting to come back to life, but they definitely aren't, ripping to the upside. But because they move really fast on a percentage basis, they're outperforming the other sectors, and money is flowing back into these sectors. So you got to follow the money. And we actually played the ARK-K ETF for a nice bounce and rally, and we're out of it already because it is showing signs of weakness. But this gives you a good visual of, this is the emotional roller coaster ride most people have. And unfortunately, most people bought during this euphoric phase, somewhere up in this area, and it's down, 70% right now. And so these people who all bought in this euphoric phase are thinking, hey, I want to get back in. I'll average in. I'll try and buy some more. But the reality is this could very easily turn into something a whole lot uglier and continue to go down and sell off with the stock market if we enter another bear market. We could be very far from the lows still, but people don't see it that way. They think the cycle's over, it's going to start going up again, but a stock can always go lower. And that's what people don't seem to understand, is you don't need to pick a bottom. You wait for it to show signs of an uptrend and then jump on board. Don't ride something down.
And then don't become, religious about it just because you made some money on it, right?
Yeah. People fall in love with things all the time. And that's the problem. If you get emotional in the markets, if you love something or hate it and you trade with revenge and try and double down and keep averaging down and hoping for like a rebound to make your money back, that's how you blow up accounts. That's how you lose money. But everybody does it. It's if you don't have a strategy in place, you don't understand the basics and how the market moves and position and risk management. I mean, you're toast in the long run. You might make money for a couple of years, but eventually you're going to give it all back. And people don't realize that. Like a lot of our subscribers have been trading for 10, 15, 30 years. They still use our service because they talk about how it just keeps them level-headed. And if they don't have a game plan to follow, their emotions will lead them astray. It's very easy to be, manipulated by your emotions and not really realize what you're doing unless you've got a game plan and saying like, why am I still in this? Everything is telling me I should be out. And it's just your emotions, right? So everybody needs kind of a helping hand.
Yeah, that's something you and I have talked about. And just on the show in general, we've talked about many times is trying to take your emotions out of those trades and stick to that process that you hopefully have in place to begin with.
Yeah.
So Chris, you're talking about a larger bear market or larger drawdown here. What are the kind of, I know you said you don't care about the fundamentals of that, but at some point, does the Fed not step in to try and save that? What do you think is the 5,000 foot view on why that bigger bear market is something that you foresee coming here?
I mean, I'm not really predicting it or saying it's going to go there. I mean, I just follow price, but when you look at the ratios of, the price of stocks versus commodities, we're so far out of whack in terms of what's going on. Stocks are just, nosebleed pricing. And we've had this massive rally that's lasted, 10 years. And there's just so many things going on. I think this market needs a big correction, but the markets, the financial systems have a way of always figuring their way out. And the Fed's done a very good job at reloading its gun. I mean, before when it had like zero interest rates, it couldn't really cut rates. Now it's got tons. Every quarter basis point is a bullet it can fire into the market and create a spark. And they just keep, trying to reload that gun as quick as they can each time and stuff it full of as many bullets as they can, because they're probably going to need it down the road. And the Fed typically gets scared pretty easy, and they just start firing off that gun to try and soften or support the market, soften the fall. I think they always do something. I think right now they're just in the mode of trying to satisfy people and try and get, inflation under control, get those rates up, which, it's kind of a win-win depending how you look at it. They're trying to get rates up so it'll help reduce inflation, but they're also loading their gun at the same time. So if things collapse, they can start trying to support the market by cutting rates again. That's how I see it unfolding anyway.
We've spoken before about your BAN list, your BAN or best asset now. So what are some of the assets on that list?
Sure. Yeah. I've got it here. If we were to pull it up, we've got TAN. Whoops. Oh, I just messed the list up, but here we go. So TAN is top of the list. It's actually one of the only hot sectors we're still in at the moment. We just took 15% gain on it a couple of days ago. This one, I've talked about it a few times as our weekly trade tip. It still has some pretty good potential to rally up into the high 90s if we get traction here. So TAN is top of the list. It's done very well. It's built this beautiful double bottom. If we look here, we can draw a double bottom formation. It's got a very nice kind of base right across here. It has broken out. It also has this rally and this consolidation, which is a bull flag, which points to, higher prices up here. So this is kind of the top pick. It's been our best performer so far. And I think it still has some room to run. I think it could run quite a bit more from where we are, but the stock market needs to get traction. The S&P 500 and the NASDAQ right now are on the cusp of blowing up and taking off to the upside, which will send stocks dramatically higher. We'll start this complacency rally that I've been talking about, or the market is about to roll over and take a nosedive and catch a lot of people off guard. Just as the people get confident, the market pulls the rug out from underneath them. And that, I don't know where we're going to go. I was talking to subscribers this morning. I said, we're in perfect position. We've closed out like 5 trades. We've got profits on all of them. We've locked in gains. Doesn't really matter what the market does from here. We would like it to go higher, but if the market rolls over and dies here, we're just going to get, our trailing stops are going to get triggered. We'll lock in more gains. So we don't really care. And that's a nice thing about technical analysis is we don't care what we buy. we don't get emotionally attached. It could be something we're not interested in it at all, but if it's performing, we get into it. And that's where, we kind of divide among most other traders. People like to trade things that they like versus what is actually probably the best. TAN and clean energy, consumer discretionary seems to be at the top of the list performing. It's put in a bottom. It's already popped and broken here to the upside, starting to run. These are some pretty high momentum moves. So everything's above the 5-day moving average and can really have a big pop and explosion over the next couple of days. So we just have to see which way this market is going to break.
So when you're looking at some of these assets or these asset classes here, Chris, are you basically just seeing it break out above one of your, let's say 5 or 50-day moving averages, and that signals a buy for you?
So we're looking for a bunch of different things. We put cycles, we put momentum, we use moving averages, we use different strengths. So as you and I were talking just before we came on here, we need price to be above the 50-day moving average. That's kind of just the basic, like it's got to be above that. And then of course we want the stock market to be favorable. And so if we look in this bottom red line down here and this green line, when it's red, that means the stock market is unfavorable. Big money is moving out of the stock market. And so if there's red, we don't want to buy any sectors because they pretty much all will go down with the stock market. If it's green, we want to get in and play the market. The market should be going up or holding sideways. And if you're in the leading sectors, they should continue to be rocketing higher. And so we've just kind of re-entered this green. We've had a really nice pop and run. And as you can see here, as soon as the market turns green, these leading sectors just pop and run. And that's the key here, is knowing when to be in stocks and when not to be in stocks. But people think they always need to have positions on. They think cash is wasting your money. They think inflation is going to eat them to death. I mean, cash is one of the best positions that we do. We're in it for 3 to 4 months of the year. If you were to combine all the times that we're scaling out of positions and waiting for new trades, but we can trade the US dollar index. So for example, if we get out of stocks because they're not favorable, we got red on the chart. Bonds are not favorable because they're red and trending down. Then we can drop to the US dollar index. And if it is trending up, which has been one of the best trades of the year, we can move into the dollar index, and our cash is in the index rising in value. I mean, the dollar is up like 6% this year. Well, the stock market was down like 20%. So there's ways to move your cash to some very lucrative opportunities. And what's really nice is I don't have it on this computer here, but an example would be the SP 500 over a 20-day window was moving about 14% from the extreme high to the extreme low. Bonds in the same time window is moving about 8%, so just over half of that. The US dollar only moves about half of what bonds do, about 4%. So when things get chaotic and nothing is favorable, we're actually stepping back to cash and then moving to like the US dollar index, which is really low volatility, very slow moving, but it's still trending up. And our key is to constantly shift our money to whatever asset is moving up, whether it's a fast moving index, bonds, or a currency. We just naturally keep shifting to whatever is moving up. And as soon as something moves out of favor, we're out of it and we look for the next one. So that's how we kind of work on getting consistent growth out of this market.
Yeah, it's interesting that you mentioned the DXY there, because I was having a conversation yesterday with a friend of mine, and we were looking at a paper that was written in April, and the DXY was at 102, I believe. And I think we're exactly as you're showing here. We're at what, 116 or something like that. So yeah. Cash wouldn't be a horrible place to be over that time frame, right?
Yeah. I mean, it's been a great trade. You look at it for just this year alone. I mean, it's just been up and to the right, very, very slow moving. You don't have huge crashes and moves. A massive big move for the dollar index is like, 1.5% day. That's a pretty big day, where the stock market is averaging, I mean, from the highs and lows each day, it's averaging like 2.5% a day. It's pretty big volatility. And it can do that day after day after day and create those huge drawdowns or rallies. So the dollar is really nice. It kind of drifts around. Currencies have beautiful trends, and they're just a nice low volatility trending asset that if, the number one asset everybody should own when it's favorable are US stocks. I don't think you should hold any bonds. I think you should be 100% in stocks. But if stocks aren't in favor, then I think you go to treasury bonds. If they're not in favor, you go to the dollar index. If it's not in favor, you literally just sit in cash in your brokerage account and wait for the chaos to finish, the market's collapsing, correcting, and then get back in at hopefully a much lower price and ride up the next rally going forward.
So we spoke about some of your ban list there. Where do you see the metals at right now? Are we at possible lows? Do we have lower to go? How do you see the chart at this time, Chris?
Yeah, I think the best view from a really high level is to look at the quarterly chart. And if we look at the quarterly chart or the monthly chart, either one, we got into this bull market phase when we broke out of this basing stage here. So we were in a stage one base back over here, multi-year base. And then we broke out in 2019. We saw gold move up, and now it's more or less, kind of consolidating in this big range. This is a big bull flag pattern, which points to about $2,700 for gold, which I think it's going to hit. The only thing is, if the stock market goes into a bear market, I think gold will stay in this range and be under pressure until the bear market ends. Typically, when stocks sell off and there's panic selling, margin calls, gold and miners will pull down. So that could last still another, 3 or 4 bars. Each bar here is 3 months. This is the quarterly chart. So we could still be out another year, another 4 or 5 bars before we start to see gold and miners really, really take off and start that next major bull market run to 2,700, potentially like into the mid 3,500 range, somewhere in there. So there's a lot of upside potential, but I just don't think the stars are actually going to fully align for another year or so for that. Now, when we talk about the complacency rally, if we see this complacency rally unfold and we see miners start to take the lead, miners and gold will work themselves probably back up to the upper end of this range. And then we start the bear market, and then it'll probably come back down, and then it'll probably flounder in here until the bear market ends. So I still think there's a lot of upside potential just to get back to the upper end of this range for gold. And I think miners will do well. In fact, if we look at the miners on our hot list, SILJ and let's see where GDX is at the very bottom. So gold miners are like one of the worst, some of the worst sectors right now in terms of where the money is flowing. So I'm not a bottom picker. I know there's people who want to go out there and pick a bottom. But you never know where that bottom is. Things could go a hell of a lot lower. If you try and pick this, things could get pretty ugly. So we're going to be watching this hot list and watch these miners. It won't take long. They can come to life very quickly, and they can hop, skip, and jump all the way to the top of this list. And if we get a new signal on the stock market to buy, they could be the sectors that we're jumping into. And they were at the top of the list early this year. When we saw gold miners rally up here, they were right at the top of the list. We just didn't get the signal to get in because the stock market rolled over. And then, of course, they sold off with the stock market. So they're not far. I mean, we're probably, weeks or months away that these things are weeks or a month before they could potentially be at the top of this list and give us a new buy signal.
Chris, if we look at more of the daily chart, of course, last week we saw a seemingly really quick breakdown below that $1,700 level. But do you see that $1,700 level as real major support in the for the gold futures right now?
Yeah, that 1,700 to 1675 area. If we were let me just clear this chart. If we just draw a horizontal line across here, you can see this level right across here. Very, very significant level. So obviously very clear resistance, very clear support. And then we had support. And here we are back with this kind of very important tag. And it's kind of like tag and go. It's a nice reaction bounce. But we're definitely getting into resistance. 1,800 is a resistance area. Simply, if I draw a line across here, you'll see how it connects so many important kind of pivot zones. So we've got where we are now. We had a breakdown, a pivot low, traded right through the middle of kind of a lot of noise here, this whole whipsaw price action, pivot lows and then pivot highs. So we're definitely at resistance, and we're ping-ponging between 1675, 1800, and 1800 is a whole number. So there's naturally going to be investors and traders saying, hey, if it gets to 1800, I'm selling my gold. And it becomes a mental resistance area. And so that's kind of why we're stalling and struggling here, is because it's that, but it's also a level that there's a lot of volume traded at this price point. So anyone who bought at 1800 a long time ago and just suffered that loss, now that it's getting back to break even, they're like, you know what? I think I'm done with that. And they want to get out at break even. So that's where that selling pressure comes in. And we'll see if gold can get some legs and break above it and become a leader here and head back up to 2000 or 2080 over the next couple of months as a complacency rally type of trade.
How about the silver chart, Chris? Does it look very similar? Are we seeing the same types of support and resistance in the silver chart as well?
It's a little uglier. Silver's always got a pretty volatile chart, and it's always piercing through supports and resistance levels. The equivalent line would be, right, this blue line here for gold. Silver broke through that, and it is definitely still trending lower. But silver does this all the time. It's kind of like a free-spirited commodity. It likes to just wander around with lots of volatility. But when gold, they pretty much all bottom together, and they generally all top together to some regard. So we'll have to see if silver can get some traction and preferably get above $22 an ounce. If it can get above 22 or this high over here around 22.50, that would be a very good sign that it's got great upward momentum. It's broken some resistance areas, and the first pause or pullback after that can be bought. And then I would think it would potentially rally all the way back up to, this 28, 29, stretch maybe 30 area during the complacency rally if that unfolds. So there's some great upside potential in it for sure. There's a big range that precious metals are trading in right now.
Mm-hmm. So Chris, when we're considering the metals, I think as a larger extension of that, we always think about the greater commodity complex as a whole. So do you see us maybe being closer to the beginning of a bigger move for commodities here over a longer time frame, or how do you see that?
Yeah, I do. So if we were to kind of look at it from a high level picture, I think we're going to see, I think commodities have started their super cycle. They started in 2019. And right now, I think they've had their big run. Oil's kind of peaked for this first major kind of bull market phase. And I think commodities are overall going to struggle for, 8, 10, 12 months. I think they could rally up near the highs again, but overall, I don't really see them breaking to new highs. I think the US dollar still has quite a bit of upside potential. It's at like 106 right now. I think it could go to 116 or 120. Which is a previous high. When you look at the dollar index chart and you go to the monthly, you can see where it has been in the past. And more or less, I think we could come back up to 116, 120. So there's a lot of room to go there. That will put some pressure on commodities. But if the dollar gets up there, and when it does, and it starts to roll over, that is what I think will spark the commodity rally. Because I think from there, the dollar really only has one way to go. I think more or less it's going to go down. And I also think at that point, the stock market will have had its bear market. It will have bottomed out. And that's usually when commodities really come back to life. Gold and silver miners should be the first one to recover. Before the stock market fully puts in a bottom, gold, silver, and miners should start to rebound. And the dollar should be topping out and falling. And that's when all the stars align for the commodity space. And I think we'll see a 3 to 5 year run to the upside and commodities could get pretty gnarly, really expensive, which could be hard on inflation. So it's going to be very interesting how things unfold.
Chris, you mentioned earlier that you look at some relationships and ratios to help guide your decision making in certain areas. So can you share with us a couple of those relationships and what they mean to you, what they point towards?
Yeah. So in general, I usually use the S&P 500 as the stock market, kind of the barometer, the overall, stock index. So I like to always look at the S&P 500, and I generally compare the SP 500 to a lot of different things. I like to look at how the SP 500 is performing compared to bonds. If the stock market is outperforming bonds, the ratio is moving up, then more or less we want to. It's kind of a check mark for owning stocks. It means there's more potential in stocks. Money is flowing into stocks versus bonds. I also like to see what's going on with the SP 500 and utilities. If the SP 500 is outperforming utilities, then we know that money is still wanting to go into growth stocks and the stock market in general. But what we saw before, when we saw this peak here just before COVID, we saw precious metals and miners like outperforming the stock market. We saw utilities outperforming the stock market dramatically. I think utilities rallied like right in this little window right here. I think utilities rallied like 6 or 11%, and the stock market only moved up like 2 or 3 or 4%. And that is like a huge red flag. If big money is flowing into utilities or in defensive sectors like consumer staples, precious metals, that usually means we're going to see some type of collapse. And that's what I like to look at. What are these ratios telling us? And right now, the ratios are telling us that, hey, money is actually flowing into growth stocks, which is why we got in a couple of weeks ago. We've been managing our positions because the long-term trend is actually down for the stock market. So this rally could fail out here. But right now, you still actually need to be in stocks. So we're still bullish on stocks. We own growth stocks. We own the indexes. And we just need to see which way this market is going to go over the next week or so. It's either going to pop and rally and we're going to continue to benefit, or it's going to roll over and we're going to be moving to the sidelines and just pocketing the rest of our capital with cash. So those ratios always give you some really good insight. And right now the insight is, it's kind of even. The money is just on the cusp of being bullish, but it can flip very quickly. And you don't want to be holding stocks, any stocks. I don't care if they're utilities, if they're dividend stocks. Believe it or not, dividend stocks fall just as much or more than the SP 500 during a crisis. During the COVID crisis, they fell more. If you were to own big blue chip stocks, fell more than the overall index. So people have this false belief that utilities and dividend stocks are conservative and defensive. The reality is, when the brown stuff hits the fan, they're almost some of the worst plays to be in. And investors don't understand that. And it's critical. Retirees need to know that those big dividend stocks can do a lot of damage, but they're totally blind to how they actually perform, because they're just they bought into the false belief that if everyone thinks it's got to be right, but it's not true. If everyone, it's just because everyone thinks it's right doesn't actually mean it is the right way. Everybody's been brainwashed to just do dividend drip, reinvestment and all that stuff, but it can be pretty deadly, which I think a lot of people saw this year. If stocks and bonds crash and they don't have an exit plan, they don't have somebody actually looking out for their money to say, hey, we actually got to get out of these things and we'll get back in later. They get caught holding the bag and watching their investments drop dramatically.
So, to protect your positions here, if we do see that rollover, Chris, are you pretty much always using trailing stops to help protect that gain?
Depending on the asset that we're trading. So when we're trading like the best asset now, which are growth stocks, we're playing sectors, they move a little faster. We use a trailing stop for those because they can have a huge rally intraday and give it all back and reverse this very same day. So you could hit a target, and then by the end of the day, it crashes right after it, and it would hit your trailing stop. So for fast moving assets, I like trailing stops. When it comes to trading something slower like the indexes or bonds or even the US dollar, I typically use like a hard stop. So we get in and then we'll put a stop, 3 or 5% below it. And then when we hit our first target, then our stop will move to our entry price. And then when we hit our second target, our stop will move up to our first target price. So we just slowly kind of ratchet it up in the slower asset classes versus the volatile ones. We wanted to just like follow price up. Any price spike, we wanted to yank the trailing stop up so we can lock in as much as we can, because eventually all growth stocks will reverse and crash hard. So we want to make sure we minimize or maximize the profits.
And again, I think that speaks to having that process in place, right?
It does. We put on a bunch of trades over the last week and a half, and it's amazing. We hit a whole bunch of targets within the first couple of days, and people write in, they're like, well, I missed it. I didn't get it. And, one of them, we hit our target. And by the end of the day, we actually got stopped out of the trade. So it ended up being a nice profitable trade. We took a profit and got the rest out at break even. Yet, I get dozens and dozens of emails that flow in like, I missed it. And it's because people just lack the discipline to follow a strategy. And so many people just trade by the seat of their pants, right? You have to, when I put on a trade, I put in my target, I put in my protective stop. Generally, I put in my stop first because I used to trade futures super fast. If you're a day trader of futures, as soon as I get in, I want to put my stop in case some news event hits. I don't want to take, a $3,000 or $5,000 loss in seconds or minutes. So I enter a trade, you put in the stop, and then you put in your profit targets, and you can get fancy with them. You can bracket them. So if one gets hit, it'll cancel another one, and you can do a bunch of stuff. But if you don't do that stuff, you're going to miss, you really don't maximize the profits because most people miss out on the intraday rally, hitting a target. They miss the trailing stop, and they find out the next day that it's opened lower than where they bought it. So they had a winner, they turned it into a nasty loss. Because of that, we're actually doing auto trading. We're just getting into providing auto trading because it's just so much easier. If you let us, our strategy run and do all the trading in the account for you, it really allows you to kind of set it and forget it. And that's how you get consistent growth is you need a strategy, but then you got to be disciplined to actually follow it, adjust your stops, adjust your targets. When a target's hit, you've got to adjust your stop because now you've got less shares. And if you get stopped out without changing the amount of shares in your stop order, you're actually going to be selling more shares than you own because you already sold some off at a profit. So you're going to end up in a short position. So there is some work to be done with individual traders who don't understand position management and managing trades with alerts and stuff.
Absolutely. Well, Chris, I think that's a good place to kind of wrap up today's conversation. Was there anything else that you wanted to touch on before we do?
No, I think we kind of covered it. I mean, I wanted to kind of just show this strategy. So our core investment strategy is called the consistent growth strategy. And the purple line here goes to show how we've got this consistent growth and very low drawdowns. The purple line is what we trade is the indexes, it's bonds, it's the US dollar index, it's cash positions, versus the gray line is the SP 500. And what I'm trying to provide investors and trying to educate them on is there's no reason to be riding the roller coaster ride of the stock market. You shouldn't be riding things that are falling in value, especially when there's crystal clear trends. Like bonds have been moving lower since literally a couple of days after the COVID crash. Actually, they topped out during the COVID crash, and it's been going down for years. Yet investors are still holding bonds when they've been in a downtrend in a bear market. And so this whole strategy is focused on we only own assets that are rising. We've got a hierarchy. So we want to own stocks. If stocks aren't in favor, we go to bonds. Bonds aren't in favor, we go to the US dollar index, and then we just go to cash. And usually one of those is moving up. Worst case scenario, we're sitting in cash and we're avoiding a lot of market volatility because I don't think anybody should be riding the market down for 50% drawdowns. And an example of the returns here, you can see CGS, which is our consistent growth strategy, max drawdown versus the SP 500, which is about a 50% drawdown. So it's really important, if we can maximize the growth, provide that consistency by moving to cash and only holding assets going up in value, you can see the power in what we're doing. And that this is kind of like the ultimate, way to trade stocks and bonds because we're only owning whichever one is best at any given time. It's kind of like the best asset, but for investors. You can, move large amounts of money into these index and bond funds. We're not getting into any sectors with this strategy. It is just stocks, bonds, currency, or cash. And that's the whole point here is to just have this consistent growth. So that's kind of our real focus going forward. And it comes down to executing trades. So hopefully that's of interest to some people, because the roller coaster ride that people have gone through over this year shouldn't really have been, with retirement capital, it should be very protected. And that's what we focus on is protecting that capital. It's better to make nothing than it is to ride something down for, 15 or 20%.
Yeah, that's a great point about, trying not to lose versus just making massive, massive gains, right?
Yeah, I read a great book on investing a couple of weeks ago called "Win by Not Losing," and I mean, it was perfect. It was right up my alley. It makes so much sense. If something's starting to lose, you just move out of it. It's really simple, and that's the nice thing about technical analysis. We follow price. We don't care which way it goes. If it's going up, we're on board. If it's going down, we're out. We're looking for something else. Super cut and dry. It's pretty boring, but boring is where the money is at. So.
Mm-hmm. Excellent, Chris. Of course, you're available at the Technical Traders and on Twitter at the Tech Traders, right?
Yeah.
Perfect. Chris, thanks so much for your time today.
Hey, always a pleasure, Tom. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.